Tom Lee said some pretty scary things in his most recent interview, and we got to talk about it right now in this video. Don't worry about subscribing, tapping the like button, or looking for the coaching and Discord link. We're going to get right into what Tom Lee said and break it down. Before we listen to Tom Lee, though, I have my free masterclass webinar I'm hosting this Friday, January 17th, 8 p.m. Eastern, 5 p.m. Pacific. You don't want to miss it. Very limited spots. Trust me, every webinar, I've got hundreds of emails coming in saying they weren't able to get in because we are full. You guys need to register with the link below right now before it's too late. Every student that's ever been to my webinar says they have learned more in the 1 hour with me than anywhere else. Huge announcement during the webinar, and I'll be hosting a Q&A, so you don't want to miss it. I'll see you guys there. Let's take a listen to what Tom Lee had to say. Brace yourselves for this.
The Dow tumbled nearly 700 points on Friday. Strong jobs report boosted the case for the Fed to hit the pause on a January rate cut. Joining us now is Tom Lee, Fundstrat Capital CIO, head of research. He's a CNBC contributor. And I referenced you earlier, Tom, because I do remember you sort of being positive overall about the market and for this year, but with some trepidation near term. And most of your calls recently have been less on the strength of the economy and more on inflation data. And some of your, like when you were calling things, S&P is going to end the week, 8% higher because of inflation or something. So we got inflation this week. There are concerns. I think I tie a lot of the weakness in the market to that. Are these important numbers?
It's important because, as you know, we've been correcting now for almost a month, right? 23 trading days. And this Wednesday is an important day because it is a possible turning point for markets. And I would like to see CPI come in below, 0.25 or so. And I think that would give that jolt of confidence for markets on top of, I think, earnings, which is going to be a positive catalyst. But for investors in the near term, I think they got to ride out the volatility because I think yields here have made people nervous. Not necessarily deteriorate the long-term outlook, but near term.
Are they smart, the yields, or are they not giving us a correct signal? Because you sound really like you're not sure about the inflation data this week.
I'll have a better sense over the next couple of days as we sort of finalize what our expectations are. But the only hesitation we have is that the hurricanes last year have muddled some of the inflation quality because, for instance, hotel reservations would go up because of these natural disasters, and it's going to happen now with the LA fires, and I think it's going to muddle used car prices as well because you have to replace all these used cars.
So you think if they weren't muddled, that inflation isn't that big of a concern? And when you say a turning point in the markets, if we've been down for a month, turning point doesn't mean further weakness. You think we might be making a bottom this week?
Yes, our technician, Mark Newton, thinks 5,700 might be the turning point. It could happen Wednesday, so maybe 2% down from here. But that's really where the market could make a stand. I think if we could lift the cloud of some of this muddling, in fact, Waller last week even said most of the inflation last year was about imputed prices, meaning the real price of inflation was actually much lower. I think that is still the case. Inflation is weaker when you look at housing, et cetera. So once we can get through that noise. But investors, I think, shouldn't be too glum. I think earnings season is going to be something that really solidifies. Look, if S&P earnings growth is 10%, X energy, and revenue growth 5%, that's a really good reason to be owning equities.
Is the Fed less significant right now with their rate? I don't care whether they, that's not what I base what the market's going to do on. Are people still just dying for another couple of cuts, or I think we're lucky to have gotten what we've already gotten. We got to live with that and just try and hope inflation doesn't come back.
I agree with you. I think the best case this year would be the Fed doing one cut because the economy is strong enough and they're still dovish, meaning they're going to make their way to neutral. But if they push those rate cuts into 2026, 2027, that's a longer run rate to support markets. Part of, I think, the hesitation for stocks right now is we have a new administration starting.
What? Oh, that's right.
Yes. And, we essentially reversed that rally from November because we rallied 7% over 23 trading days. And now we've given up 5%, and another 2% would just round trip us back to
in
November.
23 trading days.
Do you think stocks look expensive here or not? I mean, we've come back down, as you mentioned, but people keep talking about the PE ratio and how it's historically at the high end of things. Do you think it's expensive, or do you think we have the earnings power to support all of that?
To me, the 10-year, even if it gets to 5%, is a 20 PE multiple on a 10-year bond. The median PE on the S&P is 17 times. So I think stocks are giving you much better value than a bond right now. And 5% is probably not the level that yields stay at. It's probably a deflection point.
Tom, what does the movement in Bitcoin say to you? So we're at 91,000. What is that? What is that a signal or a sign of anything in this sort of analysis?
Stupid Fed.
Yeah.
It's not cutting.
Yeah, Bitcoin's down roughly 15% from its highs, which for a hyper-volatile asset is a pretty normal correction. And it is slightly following global liquidity, but we're pretty early in this halving cycle. So to me, I think Bitcoin in the near term, again, our technician thinks 70,000 is where we can sort of make a stand. Means you're getting a big opportunity, because I think Bitcoin's going to be one of the best performing assets.
So hold on, but you still think it goes all the way down to 70,000, or you think that's the floor, in which case you would still buy at this price?
Yeah, so there's Fibonacci's. So one level would be 70.
Let's say that again.
There's retracement levels. So you pull back from where you rallied.
Right.
So 70 is one level. It could go to as low as the 50s. But that's, again, not a new level. It's just where it touches before it begins to rally.
Okay, let me ask you a different question. For those folks who are watching who are not in Bitcoin or are thinking about buying Bitcoin at these prices, are you saying that this is a fair and good price to get in, or are you saying wait because you think it's going farther down?
You know, Bitcoin is something you need to be long-term focused. I don't think anyone's going to lose money buying here at 90. If they're trying to time this, maybe they'll get lucky and it goes to 70. But to me, Bitcoin could be significantly higher this year, you know, maybe 200, 250. So I think 90 is still a good entry point.
Now, after listening to Tom Lee, I'm sure you're pretty scared to some degree due to some of the things that he said, but I want to break all this down, and we'll start with the negatives first and get them out of the way, and then we'll talk about the positive. Now, he did say that SPY could pull back to 570, and he also said that Bitcoin had a high probability of pulling back to 70,000 or even 50,000, which shows a pretty massive pullback for Bitcoin. I personally don't think Bitcoin's going to pull back to 50,000, and I'm not even entirely sure that he thinks it's going to happen. He's just saying it's a real world possibility. But 70,000 is definitely more likely and is very possible, and I would think that there's kind of a 50-50 chance depending on how the data comes out this week. So what he was basically saying was, even though that is a possibility and it very well could happen, he sees Bitcoin going closer to 200,000 plus in 2025. And he's also stated before that SPY is likely to go to 660 by the end of 2025. But right now we're in a very weird position with the economy and jobs and just overall with the inauguration in 10 days, a lot of uncertainty, geopolitical tensions that I've covered before. But something else that I haven't covered in a recent video is that we also have to look at the used car sales and the used car data, which is going to be affected by all the fires in LA, all the wildfires. We also have to take into account, like Tom Lee said, all of the hurricanes and the hotels that were accommodating to people that were, and the fact that it is muddled used car data. And not to mention, he also explained that the data is muddled on inflation because of all of the hurricanes last year and hotels, which is kind of skewing numbers. And we have a lot of this going on because, like I said, hurricanes, wildfires, inauguration, inflation, the 10-year yield. When CPI data comes out this week, if inflation data or the number that we get is below 2.5, we are in a very good position. And like Tom Lee said, the markets are at a rebound spot because SPY was at 574 earlier yesterday and the day before. We've had a lot of pullbacks, and that's kind of like the position where SPY is poised to bounce, like he had just said. Earnings season will also solidify a bullish run because this is expected to be a very good earnings season coming up. The economy is strong, the feds are dovish, and I agree with him that one rate cut in 2025 and then doing another one in 2026 would be better than doing both in 2025 because it gives much more support to the economy long term. Like Tom Lee said, a longer runway to support the economy. What's very shocking to me for the most part is that after Donald Trump won the election, there was a 23-day rally, and now we've had a 23-day correction, which is a little bit strange considering they're the same duration. It's a little bit weird, but Tom Lee did point that out. Tom Lee explained that even if the 10-year yield and bonds had a 5%, this would be a multiple PE of 20, whereas the SPY has a median 17 times. So it's still more beneficial to invest in the stock market. Definitely, 5% is good, but not good enough to completely stifle trading, in my opinion. In fact, it's not even going to stay there. That's what Tom Lee said. It's a reflective point. Like Tom Lee said, the stocks are still better, and it's a deflection point and likely to not stay at that number. If this scares you in the market, being down the way it is, the pullbacks, all this uncertainty, I teach my students that this is a buying opportunity. You buy in the bottom, you sell at the top. When you see lots of red, lots of selling, the prices are all down, stock market is down. This is time to start dollar cost averaging, add to your positions, enter new positions, and get stocks and get companies at a discount. If this scares you, maybe you're losing money, maybe you're just getting started, or maybe you just want to retire early, I would love to help you. You guys can sign up for my training course, Discord, and one-on-one coaching at any time. InvestWithCorey.com. The link's in the information box below. You can see on the screen all the profits my students are making. I really do commit all of my time to helping students just like you. It's what drives me every single day. I was raised Catholic. My parents are very strict on me. And my dad is helping homeless veterans, and he's been helping homeless veterans get off the street for over 10 years. And we're a military family, so we have always been the type of family to try to help others if we had the ability to do so. That I would set out to do something to help others, and I created this entire system, my YouTube channel, my training course, my coaching, to help others benefit as well. But don't just take my word for it. Let's take a listen to what my student Shane had to say.
When I first started off with options, I knew nothing at all. Corey's program broke it down into very simple steps. Corey broke them down where it was nice and simple, and I was like, oh, okay, I totally understand that now.
How much are you up since the start of joining my program?
Oh, you know what? Hold on, I'll give you the exact number. Let me bring it up. On average, I was making about $2,200 a month day trading. That was average. In the very first month that I started actually selling options, it jumped up to $14K. And right now in December, I'm already up $6.4 thousand.
You went from day trading to my course, and you were able to go from 2,200 to 14K.
Correct, and I'm up 165% right now.
If someone was trying to decide between my program or another Discord, what would your direct and short message to them be?
Corey's program will save you time and make you money. That's the bottom line right there.
What would you tell someone who is skeptical about learning from someone online like myself?
I bought into multiple different programs. From my experience, Corey's is the safest, very consistent and profitable.
How long did it take you to actually make back the cost of joining the Discord?
From the time I started trading, I made my money back in 2 weeks, 10 days. If you want to count the actual trading days, 10 days. And then I just looked at it and I was like, holy cow. I'm like, I just made $14,000 this month. I'm like, that's like crazy. You know, just 1 month, it blew away, you know, almost my entire year of day trading.
What did you start off with in my program? Total capital portfolio. And what are you at now with profits?
Started off with roughly 50,000. I had 25-ish already like in stocks. And now I'm up to 75,000.
So you heard my student Shane had to say, this could be your success story. Do not wait. Do not hesitate. Time is of the essence. If you guys want to continue to learn, make money, retire early, make safe retirement, passive, consistent income, I would love to help you. Go to InvestWithCorey.com, click on training, watch that video, and then you'll be able to put your information in so you can book a call with my team and I so I can help you achieve your financial goals and dreams. Let's get started. Another thing I want to explain to you guys about the market is that when you have the fires like what's going on in LA right now, there's going to be an influx of people buying homes being rebuilt. There's also going to be used cars being sold. So the used car data is going to be skewed. And you want to look for stocks to make money in those situations. So you want to look to insurance companies, used car stocks like Carvana, CarMax, different hotels like Wynn Resorts as one example. And then you also want to look to other places like home manufacturing, like Builder, BLDR, Toll Brothers, TOL, and not to mention D.R. Horton, DHI, which is another stock that is a manufacturer of homes. The two biggest companies that manufacture homes are Toll Brothers and DHR. These are stocks you want to look at, especially with what's going on in LA right now. Every time there's a natural disaster or a hurricane like we had recently over the last year or two in Texas or in Florida, these are the times to invest in insurance companies, Toll Brothers, D.R. Horton, Wynn Resorts, and other hotels, as well as used car dealerships like Carvana, CarMax, or just overall in that direction of retail, because that's what's going to happen. There's going to be people buying cars. There's going to be new homes being built, hotels. Like, this is the time to look at those types of stocks. Just like when interest rates get cut, you buy into cyclicals and financial. Just like when news comes out on a specific stock and it's really good, you buy into that stock because the revenue is going to go up. Just like I told you that you'd want to buy into Best Buy in January when the stock market dipped like it's doing right now, you should be buying into Best Buy because when their earnings comes up in February, that's going to encompass November and December, which was when Christmas shopping was happening. So it's likely that Best Buy is going to report better than expected numbers, and they're going to beat the expectations, meaning the stock's going to go up and you're going to be able to sell at a profit and make some money. This is how the stock market works. I teach this in my Discord. There's a lot more to it than this, a lot more, but this is just the general consensus of how things work in the stock market. You have to understand the stocks you're getting into, understand the sentiment, understand PMI data at the beginning of every month, understand CPI and inflation, core inflation data, and you also have to understand manufacturing PMI from services PMI. You also have to understand the 10 and the 2 yield bond and understand where the bond rates are going, the APY, the interest rates that are getting cut, and if the feds are dovish or hawkish, the situation there. Each individual company you have to look at, their financial statements, the overall direction of the economy, geopolitical tensions, and political things. These all are encompassed in the stock market simultaneously in tandem, and they're deeply correlated into the stock market. So you definitely want to have an understanding of all this. Like I said, this is what I teach in my Discord and my coaching. So if you're having trouble understanding it in these YouTube videos, I would love to help you. You guys can sign up at investorcorey.com. Links in the information box below. And don't forget my free masterclass webinar this Friday, January 17th, 8 p.m. Eastern, 5 p.m. Pacific. Link is in the information box below. I look forward to seeing you guys there. You don't want to miss it. Very limited spots. Register right now before it's too late, and I'll catch you guys on the next upload. Remember, buy the dip, dollar cost average. Don't let your emotions run wild. Don't let them get crazy on you. Everything will be okay. Woosah, breathe, and I'll see you on the next upload. Take care, fam.